Today, we're diving into a new paper from the Bank for International Settlements that looks at something pretty wild. What happens when physical property, actual bricks and mortar, meets the digital world of blockchain? We're talking about the tokenization of real estate. Let's get into it. So, what if you could own a piece of a high-rise or a whole portfolio of rental homes as easily as buying a share of stock? Seriously, forget about saving up for a massive down payment. Forget the mountains of paperwork. Could you really own a slice of a skyscraper for, say, $50? Well, that is the huge promise of tokenization. But before we get to how it all works, we've got to understand the problems it's trying to fix in the first place. Because let's be real, for all its value, traditional real estate can be, well, a total nightmare. The market is just full of friction. The walls to get in are incredibly high, and the whole process can feel like it's moving at a snail's pace. I mean, just think about it. Real estate is super illiquid. You can't just click a button and sell a building in an afternoon, right? The barriers to entry are massive. You need a ton of cash just to get in the game. And the transactions themselves, they're this slow, often painful ordeal with lawyers, banks, and agents that can drag on for months. This is the old world, and this new technology wants to tear it down. So what's the big idea? What's the high-tech answer to all these old-school problems? Well, this is where tokenization steps onto the stage. At its heart, the idea is actually pretty simple, but it's incredibly powerful. You take the ownership rights of a physical property, the deed, and you convert them into digital tokens that live on a blockchain. Each one of those tokens represents a tiny, tradable slice of that property. So instead of one person owning a whole building, you could have thousands of people each owning a little piece. Okay, so here's a quick rundown of how the journey works. First, a platform sets up a special legal entity. It's called an SPV, and that entity goes out and buys a property. Then that company issues digital tokens that represent ownership. From there, investors like you or me can buy those tokens, and boom, we have fractional ownership. And here's the really cool part. As an owner, you can get your share of the rental income, often paid out weekly through a smart contract. And you can trade your tokens on a secondary market, just like stocks. No, not all platforms are built the same. Some are basically just digital notaries. They'll tokenize a property for you for a fee. Others look a lot more like a traditional fund or a REIT, where they issue tokens for a whole big portfolio of properties. But the paper we're digging into, it focuses on the most groundbreaking model, property-level tokenization. That's where every single building gets its own unique set of tokens. So what kind of properties are we even talking about here? You might be picturing these huge, shiny skyscrapers. But actually, the average value of a property getting tokenized in this study was just over $215,000. We're often talking about single-family homes or maybe a small apartment building. And this brings us right back to that question from the beginning. The average minimum investment to buy a piece of one of these places, you guessed it, about $50. This is it. This is that promise of access becoming a reality. It's totally knocking down the barriers to entry for real estate investing. Of course, this amazing service isn't free. The platforms usually take a cut, right? On average, it's about 2% of the monthly rental income. And this number is super important because it shows us the price investors are actually willing to pay for these benefits, for fractional ownership, and, as we're about to see, for the promise of being able to trade easily. All right, so we get the how, but now for the where. And this leads us to the first really big, surprising finding in this paper. If you can tokenize any property anywhere, where is this technology actually taking off? You'd probably guess that these platforms are targeting the hottest, most expensive real estate markets, right? Luxury penthouses and booming cities. That seems like the obvious place to start. But what the data shows is something else entirely. It turns out tokenization is actually thriving in the exact opposite kind of market. While the big money in traditional real estate flocks to hot markets with high prices and rock-solid economies, tokenized properties are popping up in undervalued areas, places with weaker economic fundamentals, lower demand, and, you guessed it, less liquidity. So why? Why on earth would they do that? Well, the paper points to a really fascinating reason. Tokenization isn't trying to compete head-to-head with the big banks. Instead, it's filling the gaps that traditional finance leaves behind. These colder markets are often what you'd call credit deserts. They're underserved by banks and mortgage lenders. It's just harder to get a loan. So tokenization is stepping in to offer a whole new way to invest where the old ways are failing. It's actually opening up new doors for local investment in places that have been ignored for a long time. So we've established that tokenization can provide access. That's a huge check in its favor. But what about that other massive promise? Liquidity, the ability to buy and sell your stake without a hassle. The researchers came up with a pretty brilliant way to test this under some serious pressure. They looked at what happens to trading activity for these tokenized properties when they're located in an area that gets hit by a sudden natural disaster. Think about it. It's a perfect, unexpected external shock. In a normal market, an event like that should cause liquidity to just completely evaporate as everyone panics.
So this really is the million-dollar question for this whole technology. When disaster hits, when things get really bad, do investors get stuck holding worthless tokens, or can they actually sell them? Does this system work when it matters the most?
And the answer is a massive "it depends." On platforms that did not have a buyback feature, trading totally cratered. Liquidity vanished, just as you'd expect. But on platforms that did offer a buyback guarantee, basically a promise to buy your tokens back at their last appraised value, trading activity shot up by about 35%. It turns out this one feature, this centralized safety net, was the only thing that kept the market flowing in a crisis. And that discovery right there exposes the fundamental tension at the very heart of this new technology. Because the thing that solves the liquidity problem creates a brand new and potentially very serious risk of its own. So here's the trade-off. For you, the investor, that buyback feature is amazing. It delivers on the promise of liquidity. It means you can get your money out, even when things are going south. But for the platform itself, it creates this massive risk. The platform has to keep a ton of cash, ready to buy back all those tokens that people are rushing to sell. If there's a major crisis, that could easily bankrupt the entire platform. The paper's authors really hit the nail on the head with this quote. There's a real irony here, isn't there? We have this revolutionary technology that's built on the whole idea of a decentralized blockchain, but it seems to only deliver its biggest selling point when a centralized, trusted player, the platform, steps in to save the day. And that leaves us with one final crucial question. Tokenization is clearly opening up access to real estate, especially in markets that need it most. But the liquidity it promises seems to depend on a centralized safety net that introduces a whole new kind of concentrated risk. So as this technology continues to grow, we have to ask ourselves, is that a price worth paying?